Welcome to this 2026 executive briefing. We are at a definitive turning point for Japanese corporate governance. The 2026 revisions to the Corporate Governance Code represent more than just a minor update. They mark a fundamental shift from a compliance-first mindset to a focus on genuine value creation. This briefing will outline how these changes aim to realize offensive governance, driving sustainable growth and mid to long-term corporate value through transparency and decisive leadership. The era of box ticking is officially over. Our philosophy has evolved into a lean, principle-based approach, where the comply or explain model now demands deep, unique narratives instead of generic boilerplate text. Action is the new priority, transitioning from defensive governance focused on risk management to offensive governance, centered on capital allocation and strategic growth. We will focus on 4 strategic pillars: optimal capital allocation, board effectiveness, global sustainability standards, and meaningful shareholder dialogue. We must address a stark disconnect between corporate and investor perceptions. While 82.4% of Japanese companies believe their cash reserves are adequate, 66.7% of investors view them as excessive, pointing to severe underinvestment in R&D and human capital. Furthermore, while 90% of management feels their ESG initiatives are firmly linked to strategy, not a single investor surveyed believed they were sufficiently linked. Investors are now demanding direct CEO involvement in strategic dialogue to bridge this gap. To streamline the code, we have implemented a rigorous funnel process. Critical value creation items, such as diversity goals, policy shareholding reductions, and early AGM disclosures, have been upgraded to mandatory principles. Procedural how-to items have been shifted to non-binding interpretation guidance to allow for flexibility. Finally, duplications with existing legal frameworks like the Companies Act have been deleted. This forces boards to proactively explain why their governance structure serves their specific strategy. The data reveals a stark reality. Japanese firms hold significantly more cash relative to total assets than their US and EU counterparts. Conversely, our growth investment ratios in CapEx and R&D are trailing behind. The era of passive balance sheets is ending. Boards are now explicitly required to verify that cash is being utilized effectively for growth, including investments in human capital, intellectual property, and IT, and must clearly explain their optimal balance sheet targets to investors. We have achieved high numeric compliance, with 98.8% of prime market companies now having at least 1/3 outside directors. However, meeting the number is no longer enough. The focus now shifts to the strategic role and quality of these directors. We need directors capable of debating strategy on equal footing with institutional investors and taking active leadership roles in special committees. This includes driving corporate value during acquisitions and taking full ownership of CEO succession planning. While prime companies list an average of 7.9 skills per director, a mere 17.2% actually define those skills and rigorously justify their selection based on company strategy. The 2026 code mandates a shift from simply listing skills to proving that the board's composition matches its specific growth trajectory. Transparency is no longer a luxury. Boards must show the strategic justification for their makeup to demonstrate they are fit for the future. To support elevated boardroom debate, we are introducing a formal company secretary function to Japan. The code encourages consolidating fragmented secretariats, such as legal, HR, and strategy, into a unified corporate governance office. This office acts as a strategic hub, eliminating silos and proactively supporting independent directors with vital information. This shift ensures that boardroom discussions move from simple operational updates to high-level strategic foresight. Global alignment on sustainability is here. The code now integrates SSBJ standards, with mandatory application for companies with a market cap over 3 trillion yen, starting in March 2027. This requires rigorous disclosure of climate transition plans and human capital strategies, along with mandatory third-party assurance. As we move toward 2029, these requirements will extend to companies with a market cap of over 500 billion yen, making sustainability a core pillar of corporate value. Transparency has become the new baseline for investor trust. A significant 81.2% of Nikkei 225 companies now disclose core financial and governance data before the annual general meeting. The 2026 code mandates this early disclosure to shift AGMs from ceremonial approvals to substantive strategic dialogues led actively by the CEO. Providing investors with sufficient time to analyze information is critical for fostering constructive and purposeful dialogue. In conclusion, form has been replaced by substance. The 2026 revisions cement our transition from defensive to offensive governance. By creating a cycle of optimal capital allocation, board agility, and adherence to global standards, we can achieve sustainable corporate value. Companies that embrace this principle-based blueprint will secure the ultimate competitive advantage: the trust and partnership of patient, long-term global capital.